On the southwest outskirts of Sydney, first home buyers and middle-income families are moving into the mortgage belt.
We're still a sleepy little community, but the development going on around the town is extreme. Lots of new housing developments around the area. Always give you the cheapest option and move you through.
Business owner Trudy Pettit has heard some whispers of cost of living pressures from her salon chairs.
I had a conversation with a client just this morning about rent increases, steel supply increases. I think they're not stressing a lot at the moment, but it is coming.
Trudy says her clients aren't trimming their spending yet, but elsewhere cuts are looming. Westpac's closely watched consumer sentiment index tumbled in February after the interest rate hike to levels of pessimism worse than the global financial crisis. Attitudes towards major household purchases plummeted to their fourth lowest in 48 years, while views on family finances compared to a year ago had the weakest reading since the early 1990s recession.
Well, the flow through to the broader economy will actually be quite simple. You're looking at something like 1 million households, that's about 10% of Australian households, having to cut back their spending significantly.
Economist Shane Oliver says Australia is now just as likely to fall into a recession as it is to avoid one.
It's like bringing down a A380 plane onto a very small runway in the middle of a storm.
And I don't know what else we could realistically cut back on now.
Melbourne homeowner Lorna Zelenak and her partner are middle-income earners who are now reconsidering their budget.
Usually we would spend more money on holidays, even just dinners out, going to shows, things like that. However, we've definitely pulled right back on that. This is Lorna speaking.
Lorna owns a cosmetic injectables clinic. She worries if her clients feel the same financial pressure, it could hit her income.
We made sure that we could pay back our mortgage, if it got as high as 9%. However, we're basing that on steady incomes going in. But for me, that relies on business and clients coming into the clinic.
There are more hits to households coming. Even for those on variable rate home loans, there can be a lag of several months between rate hikes and that flowing through to higher repayments. And for those rolling off fixed rates in coming months, KPMG estimates they'll be paying an extra $16,500 a year on a $600,000 home loan. In October, the Reserve Bank's own analysis found if the cash rate rose to 3.6%, just over half of variable rate owner-occupier borrowers would see their spare cash flows decline by more than 20% over the next couple of years, including around 15% of households whose spare cash flows would become negative.
We're just one rate hike away from that. So that the risk there is that you do have more households going cash flow negative, causing more problems for the economy going forward and therefore a potential blowback impact for the banks.
But the banks say customers are still well positioned to weather higher payments.
Going into the interest rate rises, we've had consumers further paid ahead on their mortgages than we've ever seen.
Business owners will be hoping their clients fall into that camp.
This is kind of the escape from reality, and for people to be able to get out of that mundane, stressful life.
But the economic blow of spending cuts might not be escapable.